Hey, welcome back to the Corporate Finance Academy. Today we're going to talk about finance and accounting salaries. It can be a little confusing sometimes to really understand how salaries, bonus, and other comp really works. And we're going to take you through how that all plays out. Whether you're at a big company, small company, public, private, we got you covered. So what we're going to talk about, this breaks down into cash compensation, so your base, bonus, signing bonus, equity, whether you're public, private equity. We'll go through retirement, other compensation, which can be a really big category. You have things like employee stock purchase programs, you have food, you have other incentives, vacation, benefits, premiums, and then as you weigh out all of these buckets, what are some other things you should think about? Diving into cash compensation. Base salary and signing bonus are probably the two most straightforward elements of salary. So base, this is your annual salary. And typically you're going to see it's paid out bi-weekly. That can differ depending on your company, where you work within the world. Some countries have slightly different processes, but pretty simple. And your signing bonus is typically going to be a cash payout along with the first pay period. It is generally taxed unless somehow your company grosses your bonus up for tax, but typically you'll pay a pretty hefty tax bill along with that signing bonus. And really with the signing bonus, what you want to watch out for are things like contingencies around payback periods. So they give you the bonus, but if you leave within a year or 2 years, you have to pay back all or some pro rata portion of that bonus. Then you move on to your cash bonus. So typically a cash bonus is calculated as a percent of your base salary. And you're going to see it calculated based on some combination of what your company, division, or individual performance targets may be. So an example might be half of your bonus is specific to your division's op profit and revenue and cash flow, and then you have 20% of it based on your overall company's op profit and cash flow, and then the remaining 30% is based on your individual performance against your goals. That's just one example, but that tells you that the 30% piece is discretionary. So when you're looking at your cash bonus, you want to think through what is the exact formula of calculation? And like I said, that 30% subjective piece, well, that's okay. You just want to make sure you understand it, because that makes you realize how important your individual manager can be in the calculation of your bonus. You should think about, or you should make sure you understand that typically you have to be employed at the time of the payout. So if your company pays out bonuses in April, let's say you work there the prior year all the way January through the end of December, the whole year, but you leave the company in February, you probably will not get a bonus. And then you should think about the cap. If you overachieve, you beat your targets by over 100%, does that give you 100? Can you get up to 115%? Can you get to 200%? And then you should understand the typical or historical payout. I've worked at companies where almost no one got paid the target, and I've worked at companies where regularly you get paid above your target, and I've seen, to the prior bullet, I've seen caps all the way up to 200% or more. So you might beat your targets by 15% and get 175% of your bonus. Here's a quick example. Base is super simple. $100,000 base, 20% target, you get a $20,000 payout. And this might be an example of how your payout structure works. 0%, zero payout if you're under 80% of your target, but you get 80% if you're in this range, 100% here, and this is where those caps play in. So 102 to 105, you get 105%, 105 plus, maybe this number could be 125, maybe it could be 200. And there might be more subcategories as you go up the chain. Okay, moving on to equity, and we'll start with equity at a public company. So the way this typically works is you will get a percentage maybe of your base, but oftentimes it's a more subjective number, which depends on how well the company's doing, how well you performed. But you will get some amount of your salary or some amount of your compensation in the form of equity. And companies have actually recently been shifting towards making this a bigger percentage of your overall compensation to more closely align your goals with the goals of the company. This will usually come in the form of either restricted stock units or options. And they have some vesting period. So oftentimes you'll see your award vest over maybe 2, 3, 4 years. And what that means is generally once a year, you'll get a portion of your award that vests, and now you can do with it what you want. You can action it. Sometimes you can transfer it to one of your own accounts. But you'll also see some structures where you have a cliff, for instance. So once you hit a 1-year cliff, you have a portion vest every quarter. But it'll depend on your individual company. And if you aren't familiar with restricted stock units and options, I would encourage you to Google it. But at the highest level, restricted stock units will award you a share of stock at that vest date at whatever the price of the stock is at that day. And then options are a little different. At the date of the award, there's a strike price. And if that price of the stock goes up above that strike price, now you have the option effectively to buy at the strike price, sell at the current price, and make the difference between the two. So if the stock price goes down, you effectively have underwater options, which are worth nothing. If it goes up, you have the difference between the current price and the strike price. So in a world where you have a company that's growing fast, you think the stock is going to appreciate a lot, options can actually be more valuable. But on the flip side, RSUs, unless your company goes completely under, you're always going to have something. They don't go underwater. You'll have whatever the value of the stock is at the time that you vest. So considerations, how do they calculate the grant? What has it been historically? This is just like the bonus. So you want to know how much equity you're going to get each year. And if they can show you any detail or support for that, it would be a good thing. You want to know if it's RSUs versus options, or do you have any choice in the matter? Some companies will let you pick which one you want. You also want to understand the vesting in cliffs. The strike price gets to be really important with options. I've had options that I got that I received at a peak price, and then they proceeded to be underwater and never worth anything. Taxes are another consideration. So when you exercise these, there are tax implications, so you have to make sure you're thinking about that. Moving on to equity in a private company or private equity owned company. You often get equity grants if you're in a more senior position with a company. It's an interesting world versus public because there's really not a secondary market. You have little to no cash value of that equity. The value really just depends on an event, and you're going to get some amount of shares or units, which again, it's difficult to quantify what that's worth because oftentimes the situation is at a startup, which is going to grow immensely, or it's just uncertain as to what the waterfall looks like upon some event. But ultimately, these equity shares depend on some sort of event. So it depends on the company being sold or going public. And unless that happens, you don't have any cash value for your shares. They may or may not have vesting. Oftentimes, you have to be at the company at the time of the event for your shares to be worth anything. But you will sometimes find private equity-owned companies where your share in the company vests, and even if you leave, if they go public years later or have an event years later, your stocks are still worth something. In the private equity space, you have a little bit higher risk and a little bit potential higher return. And these can be real opportunities to build wealth. That's the attraction that many people have to startups or to working in the private equity space, because you get these shares, these are very high growth companies, and your shares can effectively grow extremely fast in value. And sometimes you actually have the opportunity to roll whatever benefit you make from an event back into the company and reset the clock and again generate real wealth. A few considerations: how much would your shares be worth at various exit values? What does the waterfall look like in terms of what you get back? So those are questions you can work with whoever's hiring to try to understand, and they might not have exact, but they should be able to give you ranges of what it could be worth over the next several years. You want to, again, look at vesting, make sure you have it, or do you have to still be employed at the time of the event? It's also important to understand if you can be diluted. So can the company simply issue more stock, reducing the value of yours? And again, you're going to have taxes as a consideration when you're dealing with private equity. Okay, retirement is the next topic. This one's actually a little more straightforward. Usually you're going to have your retirement in some sort of 401k match, which they will match, your employer will match a percentage of whatever you put in. Some companies still have a pension, but that's pretty rare. And there can sometimes be vesting on match. The other thing to remember is that the IRS has a limit to how much you can put in a 401k each year. I think for 2022 it is $19,500, but don't quote me on that. You can figure that out with a quick check on the IRS website. And other countries, make sure you check yours. This is really kind of a U.S.-centric retirement policy. So considerations, it's good to understand if they match on your bonus as well, on your cash bonus. There can sometimes be vesting, like I mentioned, where the match portion you don't vest until some later date. And you also want to understand what investment options there are. So do they have several funds that you feel comfortable investing your money in, which can also be important if you're coming from a prior employer to understand if you want to roll your 401k into the new employer or if you want to transfer it into an individual IRA. Getting into other compensation elements, it's a very large bucket, many different potential items in here. So we're just going to touch on a few. So first off, employee stock discount programs. These are really great programs which typically will do something like enable you to buy a certain amount of the company stock at a 15% discount, let's say. So whatever the price is today, you get to buy it at 15%. So everything you buy, effectively automatically, you've got a 15% benefit on. So you buy shares that are at $100 for $85, instantly you have shares with $100. Now these are great programs. Like I said, they're usually capped as to how much you can buy, but the only thing to think about with this is you become very highly weighted towards your company's incentive program or your company's stock. So in the event of some sort of Enron type collapse, you are in a lot of trouble because you were so heavily weighted into that company. But again, you can sell that stock over time. You might be able to do some tax loss harvesting or something along those lines. Benefits. One, it's important to understand your medical benefits and what you pay for premiums. Also, if you're in the world where you're looking to have a family, either now or down the road, you want to understand maternity and paternity leave, and do people actually take it? And now I've seen companies that offer no maternity and paternity all the way up to 16 weeks for both, even for fathers. So, the benefits here can range drastically, but then the other thing you understand is, do people actually take it? So you'll see companies that have 8, 10, 12, 16 weeks of leave, and particularly the paternity doesn't get taken. They'll just take a week or 2 weeks. But then you have companies where it's kind of customary for people to take their entire leave. Vacation, this is very similar to the leave. what's the company's vacation policy, and do people actually take it? And are you generally expected to work on your vacation? Again, this can range drastically. It can also depend on your manager, but you should have some idea of what the culture is like, because you have some companies who almost take a strange pride in not taking vacation. Also, beware of the unlimited vacation trap, because sometimes the unlimited vacation means that people take less vacation. When you have a set target like 3 weeks or 4 weeks, you're at least marching towards something. So don't immediately fall for the vacation anytime unlimited. You have other things like gym memberships, reward and recognition, free food, nice cafeterias, catered foods, or other incentives. Companies are getting really creative here. You also have remote work, which some people view as a benefit, which is becoming more and more commonplace. Think through these, try to put a value on them, think about what's most important to you, and you can compare different job offers or different opportunities. Lastly, just a few considerations you want to make when you're looking at different offers or different companies. One is, how long do you plan to stay at the company? Because based on vesting periods and all those sort of things, it can determine whether it's a good choice or not. Is the company Is the company growing, or is it stable? And what's the level of risk? This is a general statement, but often companies in the growth mode can be much more lucrative from the standpoint of equity compensation. But also, when you're at a high growth company that isn't extremely small, you have a better trajectory to be able to get promoted over time. Whereas if you go into some very big company that has been around for years and has a lot of talent, it's going to be a slower progression up the corporate ladder. So you want to understand which place you want to play in. And sometimes you can go into a stable place to get good training and learn the basics and the foundations, and then flip over to a growth mode. You can take what you learned at the well-established company and help the growing company to manage their growth, and you can improve your career trajectory. What's your opportunity for advancement? Again, that's higher growth companies. You should think about what will the company's stock do. Is it overvalued already? Is it undervalued? But again, if you're at a growth company versus a stable company, it's a similar assessment. And then, how much concentration your employer does it leave you with? Say you're looking at a job that has pretty light base and bonus, but very high on the equity compensation, and they provide an employee stock purchase program, and the company match in the retirement is in the company stock. You become very heavily weighted towards your employer, and that might be okay. If it's a company you really believe in and you want to see grow and you're willing to take that risk, especially maybe early in your career, or if you're just somebody who has a high risk tolerance, that can be tremendously lucrative. But you just need to know what you're getting into when you start and make sure you're going in with eyes wide open. That's all we have for today. That's the Comp 101 version, just the basics. There's a lot more that you can explore. I always highly encourage people to build a comparison spreadsheet, and we're going to add one into the comments soon that you can click on to download to help you compare different offers. But please subscribe to our channel, like or dislike the video, and leave questions or comments for things you're concerned about or things you have questions on. Hopefully we can help you out.